The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everyone. My name is Megan Cox. I'm the Marketing Events Manager at Curinos. Thank you for joining us for today's webinar, Driving Customer Growth Through Strategic Retail Planning. As the industry's leading provider of data analytics and technologies, we are here to help you better attract, retain, and grow more profitable customer relationships for your financial institution. If you have questions during the presentation, please enter them into the question box in your GoToWebinar control panel. This webinar is being recorded, and we will send the recording and the deck to you via email post-webinar. Okay, Ben and Andrew, let's begin.
Hey, good afternoon, maybe even still good morning for some of you. Welcome to our webinar. We're going to spend today talking about essentially retail branch networks and the value of retail networks, specifically really highlighting a focus on kind of core customer growth. And so, as you see from the agenda here, we got a few chapters to run through, and Ben and I will be doing a little bit of a ping pong as we go through the slides. So I'll get things started here by talking about the banking landscape, and it's specifically focused on kind of core customer growth. I think as many of you have experienced over the last couple of years in a high rate environment, banks have largely been competing for deposits, leveraging rate. We do feel like we're going into a slightly down rate environment. However, cost of funds will remain elevated, and the importance of growing that kind of core customer base, which can serve as that kind of low cost funding to drive bank profitability, is as important as ever. The challenges for financial institutions can start to be shown on this slide, right? So what we've done over the last 4 or 5 years is a pretty dramatic reduction of branches, right? So this network optimization, again, accelerated by COVID, especially as you get into the regional, especially in the larger regional players, there's been a lot of culling of the branch network. I mean, if you think of that super regional bar at almost 5% a year, compounded over 4 or 5 years, you're looking at a quarter of that network is now no longer there. And why does that matter? Right? Obviously, consumers have been using branches less frequently, so there's good rationale for reducing the density of branches in some of the markets. The challenge is every time you close a branch, you actually close one front door through which you often invite customers. And as we'll see in some analysis later, typically you're losing out or missing out on about half of your new customer acquisition that normally would have come through that front door. Some of the consumers will be kind of picked up through nearby branches, so you don't lose it all, but there is definitely an impact every time you close a branch. Additionally, as we see on the right-hand chart, since pre-pandemic, we're seeing fewer new-to-bank relationships being established on a per-branch basis, right? So we've got fewer front doors inviting new customers. Even those front doors, we're having challenges bringing in as many customers. And ultimately, for some institutions, that's leading to a net decline in customers. And that net decline in customers really makes a challenge to drive deposit and revenue growth. Now, a little bit bright side is that we're obviously seeing some of these consumers are choosing to establish new banking relationships via digital. And we obviously see a real big uptick on the left on the percentage of consumers who are establishing a new checking relationship via digital. And again, this is for a benchmark, which is largely regional and super regional banks. So it does not include kind of any, digital only providers here, but this is more for traditional kind of branch-based institutions. So you see a real increase there. However, is the quality of those relationships is weaker. We see in the middle, we see lower average balances, and we see on the far right, lower retention rates for those relationships established via digital. So it's not a fair trade, if you will. You should not be willing to trade a new customer acquired via the branch channel for one acquired via digitally. What you're hoping is that your branch network continues to deliver the same number of new customer relationships as they have historically, and digital is like, kind of the bonus on top. And so that's a real challenge, I think, that every financial institution is working through, is how do I get my digital channel to perform more like a branch? But in the meanwhile, what this reestablishes is the importance of that branch network for driving core customer growth. One partial explanation for what we've seen on the last couple of pages is the changing competitive environment. And so what we see here is on the left-hand side, we highlight looking at what is the mix of consumers who are switching their primary bank relationship on an annual basis. And no surprise, the mass market makes up the largest segment of our population in general. No surprise that's the largest. But what you do see is some of the more affluent segments, while they do represent a larger percentage there of the population than is shown from a switching perspective, they're switching at a very low rate, right? So if you think about affluent people, you typically people who are older, more established in their banking relationships, are just not bothering to want to change their primary bank relationship. So it's awfully hard to catch an affluent kind of customer in motion. One definitional thing to highlight there is the idea of a Henry, which we describe as a high earner, not rich yet. You can kind of think of this as your kind of young professional. This is really your next generation kind of affluent consumer, right? And so now, because they're typically at a younger life stage, they're still making some, switches in their banking behavior. And this is actually, they're a smaller population than 7% of the population, but because they're switching at a higher rate, they're an important segment that banks are often targeting. However, what we see on the right is we see that the dynamics have shifted in the industry as far as who's capturing new consumer relationships. And we see these fintech providers, which might include a neobank like a Chime, but also include things you would normally think as a primary bank relationship, like Cash App or Venmo. We literally in our research are seeing consumers defining Cash App and Venmo as their primary banking provider, right? Which is a real shift in kind of mentality of how consumers, especially young and mass market and lower mass market consumers, are thinking about banking. And so that's leaving fewer and fewer relationships for your more traditional branch-based institutions. Now, the partial good news for financial institutions there, for traditional financial institutions, is because those the population that's where fintechs are winning most is typically on the kind of lower mass market. And so it's not creating a lot of balances moving out of the traditional banks, but it is impacting kind of customer counts. And so, as banks are working on their strategies, how do we essentially continue to attract the segments that we're most interested in? But we also have to be careful to not completely over-index and only worrying about the affluent and mass affluent customers, because there's just not enough of them switching their banking relationship each year in order to grow our customer base. So that's a little bit of the context of kind of core customer growth. And I'm going to hand it over to Ben to start talking about the value, a little bit more on the value of branches.
Yeah, and Andrew, you hit some of them. The way we talk about this is this branch paradox, and we were having a little discussion before we started today of when transactions really started to flow out of the branches. So there was some agreement that probably after 2000s, the 2000s, especially into the 2010s, we've been dealing as an industry with this branch paradox. Branches are closing. They're also opening. The networks are shrinking, but they're growing in some other communities. The consumers want digital convenience, but they also very much want a physical branch that drives that interaction. Prospects. So Andrew, you just talked about the money and movement. Prospects want more from financial services, more than they have in the past, and they're increasingly expensive to attract. So branches are old school, but they're kind of the new school. If we think of it kind of coming out of COVID, your branch network, at the end of the day, it is your biggest expense, and so it's an important kind of struggle of all these juxtapositions within retail banking for us to understand. It's also your greatest opportunity, and we want to show that through what this value looks like today. So starting just beyond banking at a retail channel level, couple of stats here that jump off the page to me. In 2023, 5.6% of outpaced, 2023, brick and mortar outpaced e-commerce. by 5%. Now that's not insignificant. And then the projection for 2024, we'll see what these numbers look like, but 83% plus of U.S. sales expected to occur in store. Again, not insignificant, and gives us a hint to the consumer, their thought process when buying. Next, Andrew, the Gen Z is also, they are, millennials and Gen Z are your branch power users, which is maybe something that, on the surface might seem like a shock. But if you think about this, the younger the generation is, the more they need financial advice, financial services to help guide them. So they're more engaged with their banking. The older generation, the older you get, the more that you get in banking on autopilot. And so you just don't need to engage nearly as much. I can tell you, I check my balances far less today than I did, 20 years ago. And this is represented here. So 10 years from now, guess what? Gen Alpha will show up here, and it'll be a very similar story, that the younger the generation is, the more engaged they will be in banking. And then by a channel preference standpoint, it should shock nobody here that as Gen Z comes into those moments that matter, they prefer the branch channel for those big moments. Applying for a loan, getting some advice, opening an account, or even closing an account, branch still takes the #1 position as the preferred channel. Now over on the right, you see digital channels are taking #1 position in what we would associate with the teller rows, those transactions. The reason for visiting the branch, though, the financial advice is still the top reason for that visit. And so it gets me into, we think of this new purpose in four blocks. First, the purpose of your branch, and this is from a consumer point of view. The purpose is the front door, that acquisition that they're expecting. The acquisition that we expect. That front door is that beacon in the community. When a customer is trying to determine what their next branch or next bank is going to be, they think about that branch on the corner, and that's an extreme value. The other purpose, financial advice, we showed that. Financial advice is an expectation for consumers of the banking industry. So that kind of registers as the #2 purpose. Human service is when things go wrong, you want to be able to look someone straight in their eye and trust that they are going to fix it for you. So that's another purpose for branch. And then the basic transaction. As much as we've seen transactions run off into other channels, there is still cash needs that we have to address in the lobby of the branch. So these 4 purposes are for the consumer. There is absolutely a win-win here for us, because each one of these values, and go on to the next one, Andrew, correlate with the value that we can drive out of our retail delivery system. Front door for the consumer, it means acquisition for our shareholders, for our owners. Financial advice, it means cross-sell and expanding the relationships already in our portfolio. The human service, it means building loyalty and trust, because when things go wrong, that is your best moment to really step up and shine, and to keep that customer for much longer if you respond well. And then efficiency, you can absolutely drive efficiency in retail. Look, retail has the benefit of having scale. So if you can make one small tweak in the operations of your branch network, it absolutely has a major impact to the bottom line for the institution overall. So this win-win, these 4 purposes, the value for consumer match with the value for the financial institution, and this is the value of branches fall in one of these 4.
So as we think about, hopefully we've established that the branches are still important. The branches aren't disappearing anytime soon. Let's talk a little bit about how we think about approaching kind of that network planning and market prioritization. So one of the frameworks that both Curinos as well as Adrenaline use when thinking about essentially network strategies is this concept of the 4-factor. And the idea is ultimately you're trying to come to an understanding of which parts of your network, right, or which parts of your market, your overall kind of geography are better places to put the incremental dollar of investment versus another. And also, frankly, if you need to save a dollar, which markets might you look to save a dollar for? And so what we've created is a framework where we're looking at 4 different dimensions, and essentially it's a combination of those dimensions that allow you to start to get to this prioritization as you kind of see the implied strategies on the right. It's not linear, right? It's 4-dimensional, so it's awfully hard to kind of envision this, but ultimately it starts to align into what we then simplify in a linear relationship between kind of grow being those markets that you are, if you had an incremental dollar, that'd be the first place you put it, all the way down to exit, which is a little bit at the extreme, but is actually, hey, this market is really not so good for business, and all other things being equal, it might be one you would consider exiting. Now, we don't take closing a branch in a market and exiting it completely lightly. So I say that with a little bit of caution, but you get the sense of the extremes on the poles. And so the 4 factors are potential. This is really looking at market potential, right? So it's looking at demographic aspects of the market, both kind of current as well as forward looking at the potential aligned with your target segments. Which segments are you looking at? Are you financial institutions that's heavily focused on kind of the affluent? Or are you more of a, hey, we are a mass market institution and we know that is, so we want to prioritize our markets based on the markets that have the most promise for customers and members who will choose us, right? We look at the competitiveness. What's the competitive kind of concentration and intensity, right? I think everyone on the phone would acknowledge that the national banks tend to outpunch their weight in acquiring customers. So if they're in a market that has a lot of national banks versus one that doesn't, it's going to have an impact on your ability to compete in that market. Your position, your kind of relative scale, where are you the small fry versus where are you the big dog? That doesn't mean you always reinvest in a big dog market. Sometimes the markets where you have pretty good strong scale end up being more in the middle of the scale, what we call defend markets, right? Where you want to kind of defend your kind of current position and strength. And then ultimately, performance. How are the branches in each of those markets performing? And this is really to avoid throwing kind of more good money after bad, right? And so bringing these dimensions into play, you start to align on a series of kind of prioritizations. And these prioritizations really could help you understand where you might invest or not invest in a given market. And so here's just an example looking at, and this is not any real bank. This is dummied up data, but it actually does look a lot like what a kind of pro forma might look like for a market. And you can imagine there are dots all over this, right, representing different branches within the market, and it helps you highlight which submarkets would you be more interested in investing into versus which submarkets may you actually look to take out cost savings as you continue to optimize your network over time. So from that kind of market lens, right, starting at the high level, right, and decomposing the market and all of your markets relative to each other, like how do we feel about each of those submarkets? But now when we're getting down to kind of individual branch level decisions, we use another framework that we kind of call billboard value, right? And this ties back to what Ben was saying earlier around those front doors, is branches actually represent one of your strongest drivers of unaided awareness. They say, hey, I am here in your market and I am open for business. And one of the things we want to do is make sure that your network is located in places where you're going to get the most eyeballs. People are actually seeing you and acknowledging that you're open for business. It helps make the job of marketing have to do less work because people already know who you are they already know your brand. And then the marketing can really focus more on activation of actually getting them in the front door. And so we use this concept of billboard value, and you can see the example map here where we're showing different block groups and which block groups actually represent more kind of what I'll call activity or traffic. And I don't mean just vehicular traffic. I mean retail consumer traffic. Where are the big box stores? Where are the grocery stores? Where are the drug stores? We do include actually street level traffic in there as well. So we're really trying to understand where are consumers going as part of their live work patterns, and how do I make sure my branches over time are in those locations where I'm going to get seen the most. And so using our tiering system here, we essentially look at the visibility in I don't even know what the number is. It's not deciles, but whatever it is when you break something into 20. And so we're looking at, and so any of those shaded blocks on there are some of the top block groups, the top 15%, right? So red is not bad here. Red is still pretty darn good. So if your branch is located anywhere where it's red, yellow, or green on this map, it's probably getting a lot of eyeballs. And so over time, again, it's not the only decision factor you use in planning out your network, but over time, if there are ways to actually shift your network either through relocations or through consolidations or through de novos to get more and more of your branches into those high billboard nodes, you're going to get more visibility, more levels of awareness. You're going to get into the consideration set for acquiring new-to-bank customers.
Hey, Andrew, I love the I love the walk. Start macro and go all the way down. And usually, and I want to talk about network planning and the kind of the proper structure of that. And that macro to a block group level, all the way drilled down, is a very important piece of the puzzle. And you can make a case to open a new branch or close a new branch anywhere in the country. There is a case to be made. Which is where having the very strong analytics, it comes into play right up front. So the old way of thinking about network planning on the left-hand side is you take those analytics, you kind of have all the market conversations that you have to have, you arm wrestle over, close this one, open this one, change this one, 2-for-1s over here. You have all that, which is the planning part, and then you jump straight into implementation. Jump straight into, great, we've made decisions, now let's go do it. Leaving design, the experience design, the branch design that you have that is in everybody's mind is something different than it is today, as an afterthought. So you're already right in the middle of implementation and still struggling with what it is that we're trying to deliver. This old way somewhat ignores the nuance of retail banking. Because it is more than a brick and mortar, 4 walls of brick on a corner. There's so much more to it. So that's why I want to encourage, and we would encourage, a new way of thinking about network planning. Analytics is the table stake. You have to have really powerful, strong analytics that you can trust, that in the 4-factor way includes those nuanced decision points. But then strategy and design have to be intermingled together before you get into planning and the implementation of whatever it is that you're trying to create. Let's blow these out just a little bit, and I'll talk about them in a little bit more detail. Analytics have to have really powerful market planning analytics here. They must guide you in your kind of future visioning of what the network should be and the expectations that you should have of your network, whether that's growth engine, right, the low cost core deposits, or if that is at some point in time, retail needs to drive some efficiency for your institution. Analytics can answer some of those questions. In the middle, though, step 2 of this 4-step process, in the middle is the North Star strategy, building a shared vision for what retail should be. Let's have those discussions up front. What should retail be? Are we talking cross-sell? Are we talking acquisition? Are we talking, hey, what we really just need you to do is just be there, show up, unlock the door, and service those basic transactions? Those are all decision points that reside in this second step. And have definitive impact on both the design and then how you deliver your network in the future. Branch concept design is the third thing. I haven't met a retail banker yet that says, yep, we are good to go with exactly how our branches are structured right now. I certainly haven't met in many years the retail banker that says, yeah, our teller lines are great. They're still closed off, where we love them. So everybody's got some experience in mind that is a future facing experience that where they would like to gravitate towards over time. That's what we talk about when we talk about branch concept design. All these things need to happen before you get into, putting the pedal down, pedal to the metal, and starting to close open branches. Like, these things have to be documented. The decision points within the strategy and the design need to be documented. Going one step further into the design documentation, it is much more than what do we do with the square footage. We believe that we don't design branches, we design experiences. And we document that experience and exactly how each of these spaces function. So we use a zone methodology to determine what the transact zone should deliver, how it functions from an operational standpoint, how it feels for a customer, for a small business owner, for a even in the drive-through, like, what is it that we're trying to generate, and how does it feel to be inside that branch? Digital activation. So how is technology impacting or supporting your? Yeah, thanks. Not quite ready yet. But how is technology supporting your bankers? And that digital activation, like, let's enable the bankers in the branches to leverage your digital channels that you've invested in over the last couple of years. That digital activation is a key point. And then, most important of all these four is most likely, what is the staff behaviors that you're going to encourage? Look, if you put them behind a teller row, they're going to stay behind a teller row. For example, if you put them into an open lobby, they're going to feel some privacy and security concerns. So all these things have to connect, and they have to be documented very clearly before you can move. Strategy and design interact very, very well together because, and I can't tell you how many clients we've had that says, yes, this is what we want to do, and they define the strategy for their branch. And then we put it into a schematic format and let them kind of live it in 2D a bit. And the response is, that's not really what I meant. Gosh, that doesn't quite feel like what my intent was. Or the second response that we get is, yeah, that's absolutely right. But gosh, it's going to take us 3 years for the technology to catch up with this design experience that we want. So when you're thinking about network planning, now we can go to the next. There are 3 components. First, you need to think of your branch network on a 5-year plan. Look, we're dealing with real estate here. We're dealing with big decisions that have significant impact. So when you're first building this network plan, take that burden away and think about it in a 5-year span. It's a lot of roadmap. That's a lot of runway. You can put some things on paper with the intent for where you want to go in 5 years. The experience programming, Andrew, you would say it with even billboard value and all the great analytics. Every micro market's not created equal. Every branch that's serving those micro markets are not created equal. And so it's okay to have a couple of different experiences in your network that are all pulling different parts of the rope. You might have one branch that is really designed and staffed to drive small business banking. Everybody's after that small business deposit dollar because those dollars are larger. And across the street, have a branch, if there is one across the street, have it community engagement focused. That's okay, because what you're really after is this full network performance, and the pieces of that fall in that performance or that experience programming. And then a transformation roadmap. Understand what your strategy is and where you're starting. Get into phase 2, prototype, try some things, refine, remediate those pieces in the puzzle, and then and only then get into mass application across your network. I'll say this: if we're not starting with strategy and having the design conversations very much up front, that you're letting money go out the back door, because it's not all focused on the end result goal that's documented there. So that's how we think about network planning, and the three very much the components that captures a lot of that nuance of retail.
So let's talk a little bit about the importance of analytics. So obviously Ben and I are big believers that this isn't just, kind of stick your finger in the wind and feel what way the wind is blowing when you're making these decisions. These are big, monumental, multi-million-dollar decisions that you're making with your network. And the difference between kind of a good decision and a bad decision can cost you, hundreds of thousands of dollars, and even more than that if you extend the time period. So I wanted to highlight kind of two key analytic frameworks that we think about. One of them is the financial impact of a consolidation, right? And I think that there's something here that's really kind of underappreciated. I think everybody knows that if I close a branch, there's some subset of those consumers who are going to say, darn it, you closed my branch, I'm going to go bank elsewhere. We've been watching that number for more than a decade, and it has continued to get smaller and smaller and smaller. And especially if you have another kind of distribution point or another branch in a relatively reasonable distance away, they are more than happy to stick with you, right? We're talking low single digits attrition. However, there is another impact, and that is what we were talking about earlier about the closed front door, is you're going to lose some portion of future sales, future customers that you are going to forego by having closed that branch. And the insidious thing about that is you miss out on another vintage of those, another tranche of those each and every year forever, right? And so what you really need to think about when you're looking to close a branch is, what's that financial trade-off between obviously the operating expense that I'm going to save every year, which is great, right? And it starts year one, right out of the gate. I get that big savings of staffing and branch operating expense that I get to save. But what's the compounding effect of those future foregone new to bank customer sales? Plus that attrition, don't want to deny it, it's there, but it's usually, its impact is pretty much felt within the first year. And so we kind of illustrate that on the left. And what this really encourages us to think about is that you need to take some level of those savings from those operating expense savings and reinvest it. You've got to do something in order to make up for those foregone sales, whether that's reinvesting in a marketing, reinvesting in another physical branch, somewhere you've got to recoup some of those sales. Otherwise, you're essentially going to eventually move into a kind of a shrinking institution as you continue to close branches without reinvesting to drive growth. And so as an example on the right, we kind of look at the kind of 5-year NPV of a kind of example bank branch, and you kind of see the proportional impact, right? And what you have to decide is, hey, is this a good closure for me? Is this still one that economically I feel good about? If I think about the future revenue streams associated with closing that branch or not, do I feel good about the decision? It's really easy if you're only looking at a 1-year horizon. You have all of that operating expense you save, and you lose a few customers. Like that's a decision you'd say yes to all day. But if you're going to miss out on years and years worth of future acquisition, it might not be a closure that you're willing to make. Or it may be one you're willing to make as long as you hold aside some of those funds and reinvest it to kind of make up for that lost customer growth. The other thing to think about is de novo performance. And if I'm going to go put some sticks in the ground and I'm going to build a new branch, what is my, kind of over the cycle expectation for deposit growth? The challenge we're seeing here is that branches are not growing at the same rate they used to. And this is not to say we shouldn't be doing de novos. What I'm saying is be really thoughtful before you make that multi-million-dollar investment, that you've picked the right market in order to place that location, going back to some of our market planning analytics earlier, and then 2, that you've really thought about what additional support infrastructure I'm going to put in place to help make it successful. What marketing am I going to couple with it, right? What is my branch design going to look like? What is my signage going to look like? If I have a great billboard value location and I actually don't put good signage on it, no one's ever going to see that branch, right? So how do I make sure I have all of those things working together in order to drive success? Because if you look at some of these historic growth rates, and you're seeing 6 and 7 years out, and I've only got a $30 million branch, right? It's probably something that the team's not going to be very happy with the result, and that's what we're seeing across the industry landscape. But what's even more interesting, because these are obviously averages of dozens, if not hundreds of branch openings that we show in these trajectories here. What's interesting is if we pick a couple of sample banks, and I'm not going to name those banks, I don't want to call them out, but these are both banks that have made pretty bold moves over the last few years as far as building new branches. And we've only got a couple years of data on here, so that's why these lines are short. But if we look at all of the de novos for these two institutions, what you realize is that they are extremely hit and miss, right? Some of these branches have grown tremendously. Like to have a branch that's at 60, 70, 90 million in deposits after 3 years, like that's a home run. I'd build that branch any day of the week. The problem is we've got other locations that after 4 years only have 10 million in deposits. I promise you that branch is never going to be profitable. What we've seen, it's a little bit hard to see on these noisy curves, but what we see is if it's not heading on a positive trajectory after 3 years, I rarely ever see a branch recover, right? You really, unfortunately, you kind of know pretty early, but you've already made the bet, right? You've already made the 10-year lease agreement. You've already built the branch and with a 30-year amortization, right? And so it's really hard to back out of a bad bet because of all the sunk costs associated with it. So the point is, make sure, like every decision you make is a big one, and you need to increase the odds so that it's not a coin flip on whether that branch is going to be successful or not successful. You don't want to be building 2 branches just to get one that succeeds. And so the better the analytics are in making the site selection, making the design, making the signage, the supporting marketing investment to make that branch successful are super important.
Yeah, and Andrew, I would also say build in flexibility where you can. Like maybe it's not a 10-year lease. Maybe you pay a little bit more for a 5 or 7 if you can get that, that fit out opportunity. But build in that flexibility just so that that you've got, like you said, that that you've got a way out if you need it. So 2025. Look, the winners of 2025 is going to be decided by the banks, credit unions who can grow deposits, who can grow households and grow deposits. Like we've talked about that. We've beat that drum for how many years now? Whether the rates are rising or decreasing, it's about deposit growth. And it's a steep hill. It's expensive and the competition is high. The good news here is that you've got some tailwinds for you. We've covered this. There is a resurgence of retail. I mean, consumer demand, they require a branch down the street. And the retail bankers on this call, like you can leverage that desire for that human connection, and especially in the younger generations. Customer acquisition continues to be just a big importance to all internal teams. And Andrew, you said it perfectly. You've got to plan. If you're going to build a branch in a new market, make sure you're checking that marketing budget as well to make sure it's aligned as appropriately to make the big swings up instead of just the flat line. Marketing plays a big role, and if you're not going to get wet by tipping your toe in the water. Like you need to dive in when you go big, and consider even the other lines of business that can help you pull that acquisition rope. And then M&A growth. We've already surpassed the number of deals this year. I think we're at 108 this year over a 98 last year, and the deals this year are much larger, like 3 times larger in terms of volume. The indicators are that 2025 will be an even bigger year for M&A growth. I want to give a plug here for BelieveInBanking.com. It's where we post our Adrenaline posts our thought leadership articles. October 1st, there's an article about M&A growth that I would encourage you to go check out. It's an important, even if you're not in the market for executives on this call, not in the market for your new branch or your new bank that you're going to go buy, it's a conversation that you should have starting right now. because inevitably you're going to have a competitor that is impacted somewhere or another by M&A, more than likely in 25, 26. And we need to start having those conversations, because that money's in motion. That money is vulnerable in those moments. And it's good if you're watching a competitor go through it across the street. It's also extremely important to build that loyalty if you're the acquirer or the acquired.
It's definitely going to be a big couple of years for M&A. I have no doubt. As much as we've talked about the importance of branches and how they represent an opportunity for growth, I would still argue we probably have too many bank branches in the country. And so it collectively as an industry, we probably have too many financial institutions and too many branches relative to our population. If we look at this globally, that's definitely something we see. Again, that doesn't mean branches aren't integral to part of your strategy, right? Like, and you can, so I think the other thing we're seeing, I think Ben touched on this earlier too, is we are seeing a lot of banks who are investing in physical branches where they may be harvesting in one portion of their network and investing in new branches in the other. I mean, we've obviously all seen what Chase has done over the last 10 years. We've seen some really big announcements from PNC, who actually doubled down earlier this week, and many others who are continuing to invest in real estate, in physical bank branches, face-to-face customer interactions. And so, and I think that, we'll add on to that M&A, and honestly, in the M&A space is the importance of analytics in M&A, right? If you're going through a potential transaction, it's probably pretty easy to pick, if you got two branches that are across the street from each other, which one you want to keep and which one you don't. But when you got two branches that are a mile or a mile and a half apart, it actually can make a difference on which one you choose to keep and which one, if you want to take some harvesting there, opportunity there. So using the same kind of analytics you use for your own network are important to use in the context of M&A as well.
I love that you brought up all those announcements, because that's been the news cycle. Like, that's the shift in the news cycle this year on the other side of that branch paradox is, where we were talking 5 years ago about closing branches. Like, that was the branches are dead, get out of it. And now we're talking about, hey, branches are important. We're seeing, and while there's some smaller institutions likely here that don't have, a couple $1 billion laying around to build 500 branches across the country, it's extremely relevant that those larger institutions are investing. And the encouragement here, of course, is you should too.
So hitting on kind of the key conclusions really quickly so we can transition into Q&A is competition is tough, right? However, branches can be a source of growth. Markets matter, right? Figuring out which markets are the ones that you should be making in those investments in. Site selection and design matter, should be part of the entire continuum of kind of network strategy. And I would say, even in the face of digitization, branches are going to continue to be important. There's going to be a continued need for face-to-face interactions. And so thinking about how we continue to evolve our networks to serve our customers and our members is super critical. All right.
And
so
I would end too. Start with strategy. I mean, there's two places that you can transform your network. You can renovate your current existing network to deliver, and that core customer growth. Are your bankers really enabled to do that in a special way? That should be written down somewhere. And then the site selection in the new markets. If you're going to grow, a new market is a great place to do it, but make sure you've got the great analytics. Hey, hint, I know where you can get them from, and let that analytics guide you through the strategy, but then have that design that is enabling that core customer growth. Do it all before you get to planning and implementation, please.
So we got a question in the chat, and you're gonna test me off this to think on my feet. But the question is, what are we seeing for deposit expectations for a successful branch over a 3-year period, right? And what percentage is non-interest bearing? Is a really good question. I think if you haven't, and you can kind of see some of the exhibits here, I click back to the page, right? But if you haven't cleared kind of, 30, 40 million at the end of 3 years, it's going to really be tough. That branch is never going to make it to $100 million, right? And honestly, like, this is influenced by geography, et cetera, but the average branch in the United States today is $100 million from FDIC data. Even FDIC data, even scrubbed for commercial repositories. So, that's really like, in order to have a quote fair share branch, you've got to be envisioning that branch has got to grow to that level in the kind of 8 to 10 year horizon. And so it's got to be kind of, it's got to be, well on its way. If you're going to try and get there in 8 to 10 years, it's got to be halfway there, more than halfway there by year 3 or 4, because ultimately, remember, as you all know, like de novo curves start to flatten, because as you get a larger group of customers, and in that the natural attrition of some of those customers starts to, you're fighting against that tide, right? When you're starting, right, you're starting from scratch, and so you're off like you got kind of no tailwind or no kind of drag, if you will, of attrition, but it's eventually going to start to stabilize and flatten out. So, and then what percentage non-interest bearing? Ultimately, at a 3 or 4 year point, actually, we see that the mix is not that much different than a mature branch. And some of it will depend upon where we are in the rate cycle. We do see lots of banks leverage, high yield money market or CD offers when launching a branch to try and accelerate that initial deposit growth. So I would say in the first and second year, you might be a little bit overweighted, but as you get into kind of third, fourth, fifth year, it actually starts to normalize to look a lot more like a normal branch. And again, normal branch perhaps through that geography, because we obviously see different mixes by different geographies. So hopefully that was helpful. Other questions? Anyone else have any questions?
Yeah, I've got one that the question is, strategy encompasses a wide array of elements, which we've talked about, and it's about the servicing strategy and how do we ensure that these aspects of servicing strategy are seamlessly integrated into branch design. Great question, and I answer it in you've got to understand that you are designing an experience for a customer, for a small business, for a prospect that's going to come in. You're also as equally, or maybe I could make the argument more important, the second persona is that banker, the person that's going to be walking through those doors every day. You've got to make that experience as easy and enabled as possible. That will answer your servicing strategy. So an easy example here is the coming from teller line to a teller pod. What you're telling the banker is that, hey, we want you to have access to the lobby so that you can serve wherever you are in that lobby, to be untethered. Usually security and privacy and audit all have like significant questions around that discussion. You've got to answer some of those questions for your bankers to enable them to provide the service and the choreography that you're designing to.
So we've got another question. Physical branches are important, but we still have to staff them at minimal levels based on transaction volume. What are you seeing banks be more efficient at this? This is a real challenge, right? As transaction volumes in general across the industry have come down, more and more of our branches are at what banks often call minimum staffing levels. What I find interesting is either within banks or even across banks, there's no real clear absolute minimum. I see banks that get away with 3.5 FTE, and I talk to banks who say they can't get below 5 as their kind of quote minimum staffing level. I would say a few things, right? One, it obviously can be impacted by the service complexity of the branch. I mean, some of it can be layout, right? So if you've got a drive-up teller team or pod or whatever, then they can't move over. They can't actually flexibly and easily move between in branch and drive up. That's going to inhibit your ability, right? So that flexibility and use of space is going to matter. Obviously, anyone who's still got a bunch of safe deposit boxes, that's always a killer, because that can take a person away off the floor and create. So there are obviously elements of the services that you choose to deliver in the branch that'll impact that. It'll impact you, like what you still require dual control for versus what you don't, right? And I'm not saying kind of to not use dual control, but I'm saying be very thoughtful. In some institutions, I've seen an over-engineering around risk and control, and finding how to intelligently unwind some of that to create some more flexibility. I think the concept of whether you call it universal banker or use some level of cross-training or whatever, interestingly, I do think that allows you to get to a lower staffing level. What I am seeing is a real divergence across institutions. I've seen institutions over the last 12 months actually move away from universal or cross-trained bankers and go back to kind of two very distinct roles. I've seen some go kind of all in and go everyone in the branch is universal. So I would say the jury is still out around. There's definitely an efficiency element of that, but I think what people are being challenged with is they're seeing a loss of kind of performance, if you will, or sales performance associated with that. And so they're trying to trade that value exchange off between those two. So, but I think there are things that people can do, but to get your mins lower, hours is obviously another big one, right? Like the number of hours that you choose to operate and whether you choose to operate over the weekend or whatever, it's going to impact how low you go, right? So there are trade-offs to be made there, but it is hard work to lower your floor.
Yeah, and I would say also I would add to the part-time full-time mix also is another potential fix for minimum levels. But when you're having this conversation, and I appreciate this question, connecting it back to the 4 value drivers here. If you're having a minimum staffing level discussion and you're wanting to drive it down, the value that you're deriving out of retail is efficiency. It is very hard to drive staffing levels down, but then come back the next day and the regional manager walks in the door and says, we have to do more, we have to sell more, because your people, unless you've made a meaningful change in the operations of that branch, are going to say, yeah, but with what time? Because like Andrew said, like I've still got dual control, I've still got audit responsibilities. In some cases, you're still having me perfect the lien of this auto loan I did yesterday. Like there has to be some give and take. And that's why the 4 value drivers are very purposeful in the way they're put in, because they have to be very intentionally unbalanced in that way. So when you're having these conversations, just make it very, make it very clear, like, hey, this is the value that we're driving with this conversation. Andrew, there's a question about the level, the rule of thumb for how close is too close for 2 branches. And it is a depends. But we mentioned there's a couple of hypothetical examples about across the street. And there was a curiosity of a high level optimized distance expectation.
Yeah, I think what I would think about it, and yes, it definitely depends. It depends on kind of urbanicity, right? 2 miles in Manhattan is a lot different than 2 miles in Des Moines, right? The way I think about is a little bit less about individual branches and more I think about market by market, right? So if I take a market, if I take an MSA or a CVSA, and I think about what's my density, right? What's my kind of target, like, and when I think about density, I think about my branch share, right? And a little bit of it's where am I starting from, right? Am I, 6% branch share in that market or 4%? Like, am I comfortable with broadly the number of branches that I want to have in that market, right? And am I at the rough kind of target to be able to kind of compete? Because as we talked about earlier, your branch share, and obviously you can't go out and build 20 branches in Atlanta to up your branch share tomorrow, right? Like that's a long, expensive thing. But my point is, like, given kind of where I am, right? And then I would say coverage, right? So what's my density? Because that's going to drive levels of unaided awareness and get you into the consideration set for consumers. And then it's what's my coverage? Am I covering the submarkets that I really want to address, right? Are there other parts of the market that I maybe am missing out on that I think is relatively high opportunity for me and I want to be in, right? So almost think about what's my coverage. And then it's like, okay, now, are there areas where I am too dense, right? Where I have more branch share in that local submarket that I want? And then I'm down to the individual locations. And obviously, if you have a place where you probably have more density than you feel like you need, there's going to be a higher likelihood that you're going to have two branches that are more adjacent. And then you have to make the decision, do I think I can actually get away from one here? So I would almost start top down and decompose the problem, as opposed to starting with, hey, I got two branches that are, you know, a mile and a half apart. Is that okay or not, right? Because I think you want that broader context to help you arrive at that strategy. Not only am I at the right scale for that submarket, am I at the right scale of that submarket relative to what I think the opportunity is. Like, if it's a grow, like maybe I'm okay having them be, and if they're both performing really well, that might be okay. So there's a lot of context that goes into that, but I would start top down instead of bottom up at just distance per branch.
Yeah, and so JP Morgan and Bank of America put this into a very public metric. They were driving they want to be within 10-minute drive of a branch for 70% of the US population. So that's a national 70% of the US population at a 10-minute drive. Bank of America said 80% of the population within a 15-minute drive. So those are two levers that I would encourage you to kind of explore about your own network. What kind of, how far, what in terms of minute drive time are you from the populations that you serve and want to grow, and then determine what the best one is for your institution. The two across the street example is, maybe they're two legacy, two different institutions. The structure of the lobby is different. You're also trying to solve for, like, where do my line of business partners sit? Do we buy space in a skyrise, or do we put them on the ground floor? That might be another solution. So that's where you would get into that. Those two branches, even though they're across the street and kind of run against that percent of population drive time metric, ask them to deliver different services and expect the performance to be slightly different. Andrew, there's one about the customer servicing.
All right, hit it, because we're almost at time, Ben, so we'll do this one click.
All right, very quick. Should banks and credit unions continue to offer drive-through service? Do you have any data that differentiates between servicing in-branch versus drive-through? That data is very hard to get to because most institutions don't have an indicator of drive-through in-branch. I will say the customer inside your lobby should be your priority customer at any given time. If they've made a decision to bypass the drive-through, bypass all the ATMs, bypass their phone, bypass everything else, and walk through the doors of your branch, that should be the most important customer at that point. And so that leads you to drop the VATs somewhere that's being served in the lobby, so that you can do both. I don't know if I quite answered the question, but gave you a framework for how to think about getting to that answer.
Well, again, Megan will distribute a link to the recording as well as the deck. If you guys have follow-up questions, feel free to reach back out to us. We're happy to talk about branches. We talk about branches all day long. And maybe it's a little bit of a sickness, but thank you all for joining.
It's a passion, Andrew. It's a passion for branches.
There we go. Awesome. Thank you all. Have a great rest of the week and weekend.